In Monday trading, Brent crude soared to over $67 a barrel. That's the highest so far in 2015, and in fact, it's 40% higher than the near 6-year low that Brent crude hit in early January. The question that this leaves us with, however, is simple. Is the worst over for African crude producers, or is this perhaps just another false dawn? We'll be answering that question in detail from right here in Nairobi and Washington, D.C. Perspectives from all directions are coming through. I'm Ramanyang. Welcome to the program. Here's what's coming up. The hopes of Africa's most populous economy lie on General Muhammadu Buhari. We'll be looking at his in-tray. And why are North African leaders trooping to the newly crowned monarch in Saudi Arabia? We'll tell you shortly. Right then, the economic fortunes of African crude producers seem to be picking up, with oil prices firmly on the rebound, or at least that's the perception. Prices went almost to $67 a barrel. That's reaching a 2015 high. That's up more than 40% from a near 6-year low of just about $45 a barrel in January. Now, the rally, of course, is fairly good news for net exporters like Nigeria, which has seen a drastic reduction in federal government revenue, plunging stock values, and a rapid depreciation of the naira. Now, the oil price, of course, will be pivotal in Nigeria's President-elect Muhammadu Buhari's ability to follow through on his election promises. Analysts say that the price rise is being driven by forecasts of a tighter future supply and demand balance, as well as a weaker dollar and tensions in the Middle East. Now, while this is good news for exporters, a recovery will certainly hurt consumers in oil-importing nations like Kenya, which have been enjoying lower fuel prices and imports as well. Now, as we mentioned earlier, the capacity of Nigeria's president-elect to deliver on his promises ride very heavily on where the price of oil will go. Muhammadu Buhari will be sworn in as the new president of Nigeria in a matter of weeks. He will definitely need a significant boost in government revenues if he is to fulfill his ambitious economic plans. Deji Badnos filed this report from Lagos.
On the campaign trail, he made a lot of promises.
We will concentrate on the roads and highways that link up Nigerian states, while state governments will be expected to connect their states to these highways by building the last mile connections.
But Muhammadu Buhari is now beginning to realize that most of his campaign promises may not materialize if oil prices don't pick up steadily to shore up government revenue. And labor unions are already indicating that they have their gloves ready to put the government to task.
The politicians promise to give us good roads, good water, good electricity, good schools, and we are going to hold them accountable to this.
Nigeria is facing a serious revenue crunch, with oil prices refusing to pick up as fast as they declined. Monthly revenue allocations to states have dropped significantly, with a number of states unable to pay salaries.
It is a very difficult period. Everybody, not only governments, but individuals, our respective family budgets, we need to tighten the belt. Austerity has truly started.
The country's foreign reserve has also dropped to an all-time low of around $28 billion as the central bank continues to try defending the country's currency from further depreciation.
Well, the basic thing about the depleting foreign reserve is that you have to look at the structure of Nigerian exports. There is actually no quick fix when it comes to addressing the export products of the country. Today, we have crude or oil and gas accounting for about 90% of our export earnings. But the basic thing that any government should do, the incoming government should do, is to work toward diversifying our export products offerings.
Experts, however, say the good news for Buhari and his incoming government is that with the successful conduct of the general elections, foreign portfolio investors have begun renewing their interest in Nigeria and are indeed returning.
The government party have to come up with an economic policy direction that is private sector driven, that is private sector oriented. Once the government comes up with a defined economic policy that encourages the private sector to participate in the economy, then the large market that Nigeria naturally has of consumption will encourage a lot of foreign direct investors to invest in consumer goods industries.
Despite the huge shortfall in government revenue, Nigerians expect so much from Buhari and his team. But economists have warned that things may not take serious shape for the new government until the fourth quarter of this year. For now, people are waiting to see what Buhari's cabinet will look like, but he's been keen to temper down expectations, saying that people should not expect miracles from him. Deji Badmo, CCTV, Lagos, Nigeria.
Right then, Deji Badmo to set the stage. Let's expand the conversation. Wendy Onyaga is the CEO of Oil and Energy Services Limited. It's an East African consultancy on that specific commodity. He's with me in studio right now. Daniel Rangers is live in Washington, D.C. as well. Mr. Onyaga, let's start with you. Walk us through exactly what's going on here. Supply is still relatively high. Demand in China and Europe is still weak. Why are prices signaling expectations of a much tighter demand-supply gap?
Well, Rama, you know, the supply glut is not as big as anyone would imagine to cause that very significant drop in price. The glut is literally just around 1.6 million barrels of oil per day against the current consumption of 92 million barrels of oil per day. So in this kind of circumstance, all one needs to do is reduce the increase in production. You don't necessarily have to reduce production, but reduce the increase in production, and soon demand will be catching up. If you look at historical numbers, in the last 12 months, the world oil demand has increased with 1.5 million barrels per day, and in the last 24 months, 2.9 million barrels per day. So if today you reduce increase in production, then it's likely to lead to a situation where demand catches up with supply very, very quickly. And that will immediately cut on on the oil price decrease. In this case, the drilling in the US has decreased significantly, and that will reduce the growing production in the US, which then will certainly affect prices as you're seeing today.
Indeed. Daniel, let's come to you. The Baker Hughes rig count, that's been down for 21 weeks in a row. Walk us through how the composition of American oil output has changed. Has shale output fallen drastically? Has OPEC attained its objective of squeezing the Americans out of the market?
Well, if you're a smart driller, Rama, what you do when the price is high is you go to the derivatives market and sell the oil in advance to them so that you know that down the line when you drill, the price will be high when you take the stuff out of the ground. And indeed, that's what most fracking drillers have done here in the United States recently. And that's meant that there wasn't some sudden drop-off in drilling activity. However, given that the prices have now come down, your derivatives contract are not going to buy you very much, and so the incentives for continuing to explore new sites and starting to drill on new sites at this moment has gone away, and that's where you've seen the decrease in production starting to take root in the US market. But certainly inventories are still very high, as those wells that are currently in production have no incentive to stop.
Indeed, I've been seeing some interesting numbers coming out of the storage facilities at Cushing, Oklahoma. Mr. Onyaga, when we last spoke about the fall in oil prices, there was quite a bit of concern about the knock-on effect on exploration projects and new drilling across Africa. And we did see some companies, like Tullow, for example, cutting their exploration spending. Now, assuming that this price rally does hold and goes back towards $100 a barrel, how soon can we see a turnaround in exploration and exploration budgets?
Now, first, just looking at what has happened in Kenya in the last few months, we have come down from 6 onshore drilling rigs to 1 active onshore drilling rig today, which means some rigs have been withdrawn from the field. If you were to want to procure a new drilling rig and take it to the field today, it will take at least 12 months for you to tender and get a supplier and get the rig to the market to start drilling. In which case then, even if prices were to improve significantly today, then you need at least 12 to 18 months to turn around and beef up activity to the levels that you have seen in 2014 because of the lead times required, and these projects are kind of long term, so you can't just switch on, switch off within very short time limits.
Indeed. Daniel, let's focus on WTI crude. It's risen in tandem with Brent, but all things being equal, isn't this likely to give respite to some US crude producers and to some extent maintain this current supply glut?
Well, the average break-even price for drilling for shale is about $65 a barrel. So when it hits $65 a barrel, about half of the US drillers in the different sites across the United States will be in profit. But that's not to say that there are not vast numbers that are now finding cost benefits by drilling larger horizontal wells in these fracking sites, as well as the fact that in some there are profitable sites to be had even at the current levels. So it depends on your situation. Certainly there are some that are highly unprofitable to start drilling at the moment. But as the prices begin to rise, more of those sites become an incentive. And don't forget that with fracking, you have a 1, 2, or 3 year time horizon for each site. So there's less upfront cost, but then you don't have to drill for 10 or 15 years with conventional oil. So essentially the turnaround time becomes much more manageable, and the incentives to begin drilling again once the price begins to rise above $70 a barrel becomes very beneficial for US producers again.
Indeed. Mr. Nyaga, let's come to Kenyan policy, specifically the petroleum bill. It's pushing oil firms to give investors, or rather the government, a 5% stake in the business. And it's also setting a hard limit on how much local content these companies must have. Now, given the lack of skills, local skills at that, in this specific sector, isn't the Kenyan government just setting itself up for colossal failure?
Rama, the local content subject is a very, very complex subject, and especially when it comes to a technical industry like the oil and gas industry, when the risks are high at exploration stage, the spend on research and development to develop services is very, very high. When you come to setting targets and limits and percentages of local content requirement, it does require that it is based on some kind of empirical evidence on what's possible, and it also needs to take into account the stage of development of the industry. Like in Kenya, we are still at the exploration stage. We have not even started developing, and we haven't gone into production yet. In this case, there needs to be some kind of dialogue, even as the policy is being set on what should we promote, what is required, what capacity is needed for us to be able to build these. So in my view, there could be a case of cart before the horse. But having said that, I don't mean that the local content subject is not important. It is very, very necessary. It is time to have that discussion now. I just hope that the policymakers and the lawmakers would first engage in dialogue with all the involved stakeholders before they start setting numbers as limits, as percentages, and that kind of stuff.
Indeed. We'll have to leave it there for the time being. Thank you very much for your input tonight, gentlemen. Mwendya Nyaga, CEO of Oil and Gas Services here in East Africa, and of course Daniel Rangers live in Washington, D.C. Now, let's make a quick run through equity markets here for you, see exactly what your money has been doing for you across the board. One of those days when you're giving you a mixed set of numbers. Egypt, of course, rallying fairly strongly, up by over 100 basis points in trading today. The Nigerian and the Kenyan stock markets, however, all shedding some points, treading water. Really, some interesting news coming on the management front in Kenya. Nation Media Group, the largest media firm in Eastern and Central Africa, has a new CEO. It's actually poached from another NSE-listed company, East African Breweries. The new managing director will be Joseph Muganda. He takes over in July. This enormous solar power plant in Morocco is almost complete, but does it make financial and economic sense?
This is the first year that Africa will have more foreign direct investment than aid. And it's like the tipping point in terms of changing the way the continent is perceived. And I think this summit very much responds to that call. Now, whether it can materialize what is being announced is something that we'll have to check and see whether it happens.
Welcome back to the program. We're 15 minutes into the hour. You're still watching Global Business Africa. The Egyptian President Abdel Fattah el-Sisi made an unscheduled visit to Saudi Arabia over the weekend amid signs of growing political tensions between Egypt and the Kingdom of Saudi Arabia. The kingdom, of course, was a key supporter of the 2013 military coup that saw the ouster of Egypt's former head of state, Mohamed Morsi. The oil-rich nation has also been a key financial backer of the subsequent Sisi administration. That said, ever since the Saudi king Salman bin Abdulaziz took power in January, there have been suggestions that the relationship between these two sides have soured. While officials say ties remain close, media representatives from both sides have been quarreling over Saudi Arabia's apparent change in focus or policy direction. Now, it's reported that Riyadh's representative in Cairo has responded to local media criticism by filing a complaint with President el-Sisi. The Moroccan king was also in Riyadh to discuss bilateral ties. Staying on in Egypt, the finance minister Hani Kadri Dimian has announced that the government is planning to issue Islamic bonds, better known as Sukuk bonds, in the next fiscal year that starts in July. Islamic bonds, of course, were first discussed in Egypt in 2011. They were, however, postponed until a new president was in power. The former head of state, Mohamed Morsi, then tried to push them through in 2012 and 2013, but he ran into fierce resistance, not just from the public, but experts as well. El-Sisi's government is now going down the same road, but his officials say they will amend a couple of clauses in the new law that will govern Sukuk bond issuance. Islamic bonds accounted for roughly $200 billion worth of issuance in 2013, and experts say it could exceed $1 trillion worth by the end of this year. Malaysia is the largest issuer of Sukuk bonds in the world. Egypt is now looking for a slice of that market. Let's head over live to Cairo now, where Yasser Hakim is live at the moment. Yasser, Mohamed Morsi tried and failed for years to get Sukuk bonds off the ground. Walk us through what the current administration is doing to avoid the same errors.
Well, first of all, they've decided to discuss this whole issue with the public, with the media, sort of a national dialogue about retaining the Sukuk bonds or going back to Sukuk bonds, listening to both sides, positive, negatives, advantages and disadvantages. And also it will put forth a draft plan to the Sheikh of Al-Azhar and the Mufti, the two largest clerics or highest ranking clerics, Islamic clerics in the country, who had opposed the previous law that was turned down during the Morsi reign. So they're trying to take the proper steps to ensure that this law gets approved right away, especially that there's no parliament now. No parliament has been elected, so it's the president who has the legislative powers as well to get it through. But he wants to go through the public acceptance and the Azhar acceptance as well to get it all the backing for his new law.
Indeed. Let's focus on those specific objections from Al-Azhar and the Shura Council. Do these amendments that have been made by the finance minister deal with the objections raised back in 2013, or has the government just done a complete top-down revision of the law governing Sukuk bonds?
No, the government said it's not totally revising, it's just amending the laws and the clauses that have caused the uproar then, and has led to the law being rejected. So it's basically just changes and amendments in the law rather than a whole overhaul.
Indeed. We'll leave it there for the time being. Thank you for your input. That's Yasser Hakim live in the Egyptian capital of Cairo. We'll certainly keep tabs on that story. Fairly interesting approach to public finances there. Now, still in North Africa, an enormous solar power plant is nearly complete in Morocco. While this is just one part of the North African state's plan to have a lot more green power, some in the country are asking if the economic and financial costs are really worth it.
This massive solar energy plant sits on the edge of the Sahara Desert. Its mirrors cover 480 hectares of land, and once construction is complete, the plant will generate 160 megawatts of electricity. Called Noor 1, it's the first phase of the Ouarzazate solar plant being built by a Saudi-led consortium. The plant is part of Morocco's $9 billion project to build 5 solar plants, which aims to draw over 40% of its energy needs from renewable resources by 2020, 14% of that from solar power.
Today we're in the final phase of the project's development. The whole field is finished and we are working on the power block. We have received all the equipment. In theory, we will be in a position to deliver energy this year.
The latest technology sees parabolic mirrors track the sun and focus its rays on tubes filled with a synthetic oil. The liquid is heated to 300 degrees centigrade, which creates steam and drives power turbines. The project is expected to provide a significant boost to both the national and local economies.
I am sure you've noticed all the solar cells are nearly in place, and we can start to prepare to begin producing energy, which we will be ready this year. We will have the first kilowatt hour this year, God willing. This is an important national project and one of the biggest of its kind in the world. We have more than 2,000 people here, most of whom are Moroccan, and now the project is going well.
Morocco is one of the few countries in the region almost wholly dependent on imports for its energy needs. It's hoped the solar power plan will not only supply the country's own electricity requirements, but also produce enough to export to Europe. However, the investment in renewable energy is coming at a significant cost. The estimate for the plant was originally $440 million, but that cost has ballooned. While the power it produces is expected to cost twice as much as fossil energy, with the Moroccan government pledging to cover the difference. Proponents are defending the project against critics who have questioned whether taxpayers should be subsidizing the project.
We must get to a point of economic and financial competitiveness with fossil energy.
It's hoped the initial subsidies will propel the sector towards self-sufficiency.
I think the real challenge in this sector is to realign the priorities to get through this transitional phase in the best condition possible. I remember that with other sectors like telecoms, had we waited for the best prices to be able to speak on the phone, we would never have got to where we are today. That's a bit of the situation right now in our sector. If we expect solar energy to get in a single step to where we want it to be, nobody will ever do it.
Funding for the project is being provided by an array of international organizations, including the World Bank and the African Development Bank. Volde Karelse, CCTV.
Quick updates on the oil story. We covered this in detail in the first part of the program. Brent crude has retreated slightly, down about 20 cents or so. But the reason for it is a bit interesting. The Saudis apparently have said again that they will stop bombing Yemen. They said that, what, 2-3 weeks ago? Didn't happen. So we'll see how this plays out in future. Now, away from oil, let's talk about teff. It's a humble grain. It's a staple of Ethiopian cuisine, but unless you're actually a die-hard foodie or you live around East Africa, you probably haven't heard of it or eaten it. That, however, might change if an Ethiopian chef, Johan Hailemariam, has his way. As Girum Chala reports, he's drawing diners into his restaurant in Addis Ababa with teff-based versions of popular dishes.
Chef Johannes is taking Ethiopia's famous grain teff to new heights. At the Antika restaurant owned by his mother, the chef is producing teff-based lasagna and pizza.
Best food is where it's born. So if you want the best injera, of course you have it here. If you want the best wine, you go to France. And what we're doing here is really working on the innovation part, where we're mixing Ethiopian ingredients because they're tasty, because they're healthy. So the benefit of the healthy benefit and taste of Ethiopian food are not everyday products. So this is something we're doing at the restaurant right now, where we have teff-based lasagna, teff-based pizzas. So tasty, different looking, and still something you're used to.
Now, what makes Chef Johannes unique is he's trying to take it to the next level of putting teff, the local one, into the international dish, perhaps lasagna or pizza. This is called meeting Ethiopian and the international cuisine together here at his taste. Let's just try to taste what he's got. Hot?
Fantastic.
Chef Johannes lived and studied in France. He learned his international cuisine skills from celebrity chefs there. 2 years ago, he returned to Ethiopia from working at a 5-star hotel in the United States.
That was a very lovely experience. I'm very lucky for that, actually. I was in France, as you said, for several years, almost 6 years, actually. So I went to the Paul Bocuse Institute. That's where I had my first culinary experience, which is fine dining. So you get to see a lot of products. Why I come back home? Because I miss the taste. Although you see different type of taste every day, I'm still Ethiopian at heart, and also born Ethiopian and still Ethiopian. So it's a privilege and a luxury that I want in my life.
Now, Johannes and his longtime friend Michael are creating a brand, CY, for his teff-based products.
So we're working on a robust strategy to take this brand global. So we're going to have a robust digital strategy and online presence to be able to have a global reach and to be able to offer the health benefits and taste of Ethiopian food to the global population, where we're going to build teff-based and spice-based products, Ethiopian teff-based and spice-based products in the global marketplace. And the other one is through a TV show.
At his mother's restaurant, Chef Johannes is drawing foodies looking for a unique and organic taste.
The things I've enjoyed the most about being in Addis in Ethiopia is the food and the culture and injera and all of that. So when I come back, I'll have to try something that has some teff in it, because it's certainly unique and not something you see in other places.
He's the one who wants to follow my footsteps, and he's an artist. And culinary also, it's another kind of art. So he's the one who really is devoted to continue Antigua. So really he makes a difference.
While the restaurant serves a mix of African, Italian and Ethiopian cuisine, its vision is beyond a plate of food. The culinary skills of Chef Johannes are hoping to change the decades-old perceptions about Ethiopia after the 1980s famine. The ultimate goal here is to show that Ethiopia today is changed for the better, and its best days are yet to come, with more and more of the diaspora returning to cashing on the opportunities here. Grumtara CCTV, Addis Ababa, Ethiopia.
And that's it for this edition of the program. We'd like to hear your feedback on what we do around here. Global Business Africa at cctv.com is the email to use. As always, more content flows 24/7 on Facebook and on Twitter as well. I don't know about you, but I'm having Ethiopian for dinner. See you tomorrow.